Today we're looking at Alphabet. The quarter looks strong on the surface. Revenue was $119.8 billion, up 24% year over year. Operating income was $40.8 billion, up 30%. Search kept growing. YouTube kept growing. Google Cloud accelerated sharply. But the stock market did not only trade the headline growth. The important question in this report is not whether Alphabet can still make money. It clearly can. The real question is what kind of company Alphabet is becoming. For years, investors treated Google as a high-margin advertising machine. Search produced enormous cash flow. The company could invest in long-term projects, buy back stock, and still look like a relatively light-asset software and advertising business. Artificial intelligence is changing that financial picture. Search is still strong. Cloud is stronger than before. But to compete in AI, Alphabet has to build data centers, custom chips, servers, networks, and global compute capacity at a much larger scale. That is the core tension in this quarter. Alphabet is not becoming weaker. It is becoming heavier. Start with the number that can mislead people the most. Reported net income was $112.1 billion, and diluted earnings per share were $9.11. That looks extraordinary, but a large part of that number came from accounting gains on equity securities. Alphabet recorded almost $98 billion of net gains in other income, mostly from unrealized gains on equity investments. The company said this added roughly $77 billion to net income and about $6.26 to earnings per share. So the $9 earnings per share number should not be treated as the normal operating run rate. The better things to watch are operating income, search revenue, Google Cloud, capital spending, and free cash flow. Those numbers tell the real story. First, search. For the last year, the market has worried that AI search could damage Google search advertising. This report gives a direct answer. At least for now, that has not happened. Google search and other advertising revenue was $63.3 billion, up 17% year over year. That is not the number of a business that has already been broken. Management argued that AI is not only a cost burden on search, it can also expand the search experience. AI overviews and AI mode let users ask longer, more complex, more specific questions. Traditional keyword advertising was not always good at matching those questions. With Gemini inside the advertising system, Google can understand intent more deeply. The call gave several important signals. AI overviews now reaches more than 1 billion monthly users. The Gemini app has more than 950 million monthly active users. Gemini API and AI Studio process more than 220 billion tokens per minute. Even more important, management said the cost per AI mode response has fallen sharply since launch. That matters because the biggest risk in AI search is not only user adoption, it is unit economics. If every query becomes more complex and every answer requires more compute, search margins can come under pressure. Alphabet is trying to show that AI search can become new advertising inventory while the cost curve improves. So the search story is not a collapse story. It is a monetization and cost curve story. Now look at Google Cloud. This was the strongest growth line in the quarter. Google Cloud revenue was $24.8 billion, up 82% year over year. Operating income was $8.8 billion, with an operating margin of 35.6%. A year ago, the margin was 20.7%. That means Google Cloud is no longer just a loss-making challenger trying to catch Amazon and Microsoft. It has become a high-growth business that is also producing meaningful profit. And this is not just about selling generic cloud servers. Alphabet is selling a full AI stack: chips, models, data tools, security, enterprise agents, and developer tools. Customers are not only buying compute, they are trying to put AI into real workflows through Gemini Enterprise, data analytics, security products, and application platforms. The backlog number is important here. Google Cloud remaining performance obligations reached $514 billion, up more than $50 billion sequentially. Management said more than half of that backlog is expected to turn into revenue over the next 24 months. That tells us the AI cloud demand is not only a short-term burst, it is showing up in longer contracts. This is why the cloud narrative has changed. The old question was whether Google Cloud could catch up. The new question is whether Alphabet can use its own chips and models to reprice cloud infrastructure in the AI era. That brings us to custom chips. Alphabet calls them tensor processing units. In simple terms, they are Google-designed AI accelerator chips. For years, these chips were mostly understood as internal infrastructure. They supported Search, YouTube, Gemini, and Google Cloud services. This quarter added a new detail. Alphabet started recognizing revenue from tensor processing unit systems, including systems delivered into customer data centers. That matters because the chip is no longer only a cost control tool inside Google. It is beginning to become an external commercial product. This can strengthen Google Cloud's differentiation. When other cloud providers mostly rely on NVIDIA graphics processors, Alphabet can offer graphics processors, its own AI chips, its own models, and its own software stack. But external chip system sales also make the financial model more complex. They can lift cloud revenue and backlog, but they also require inventory, delivery capacity, and capital investment. Most of the revenue is expected in 2027, so this is not only a 2026 growth item. It is also one of the major variables for next year's cloud revenue and capital spending. Now we get to the part that makes the market nervous: capital expenditure. In the second quarter, Alphabet generated $39.1 billion of operating cash flow. It spent $44.9 billion on capital expenditure. That means free cash flow was negative $5.9 billion for the quarter. Over the last 12 months, free cash flow was still positive at $53.3 billion, but it was down 20% year over year. This is not a small detail. Alphabet is telling the market that AI growth requires cash to be pushed into infrastructure first. The company also raised its full-year 2026 capital expenditure outlook to $195 to $205 billion. Management also said capital expenditure will increase significantly again in 2027. That is the real reason the market reaction was not simply positive. It was not because search collapsed. It was not because cloud is weak. The problem is almost the opposite. Demand is strong enough that Alphabet has to keep spending more. The unresolved question is when that infrastructure spending converts into stable free cash flow. Analysts pushed management on return on investment from generative AI. Management sounded confident, saying demand is running ahead of the capacity built over the last 3 years. That is a directionally strong answer, but it is not a payback schedule. This is what investors have to watch. AI demand may be real. Alphabet's technology may be strong. But if every wave of growth requires larger capital expenditure, more depreciation, and more complex financing, then the valuation model changes. Alphabet used to look like a high-margin cash machine. Now it increasingly looks like a company that must bury cash into infrastructure before that infrastructure releases revenue over several years. That does not make Alphabet a bad company. It means Alphabet is entering a different financial phase. One signal is financing. In the quarter, Alphabet completed $49.6 billion of equity financing for general corporate purposes, including AI infrastructure and global compute expansion. It also issued $20.3 billion of senior unsecured notes. The company also set up an at-the-market equity program of up to $40 billion, although it had not used that program by the end of June. That is a meaningful change in the way investors should think about the business. The old Alphabet story was buybacks, cash, and advertising profit. The new Alphabet story still has those strengths, but it also has massive AI infrastructure funding needs. So was this a good quarter? Operationally, yes. Search did not break. YouTube grew. Subscriptions benefited from AI plans. Google Cloud is becoming a real AI infrastructure winner. Custom chips are moving from internal infrastructure toward external commercial products. But financially, the pressure is also real. Free cash flow turned negative for the quarter. Capital spending guidance moved higher. 2027 spending will move higher again. Equity financing and debt financing are now part of the story. That is why the market is not just looking at revenue and operating income. The real conclusion is simple. Alphabet is not a weaker company. It is a heavier company. The search engine still funds the machine. Google Cloud is accelerating. But AI capital expenditure is changing how the machine should be valued.